Deferred compensation. Deferred compensation is an arrangement in which a portion of an employee's income is paid out at a later date after which the income was earned. Examples of deferred compensation include pensions, retirement plans, and employee stock options. The primary benefit of most deferred compensation is the deferral of tax to the dates at which the employee receives the income. United States. In the U.S., Internal Revenue Code Section 409A regulates the treatment for federal income tax purposes of non-qualified deferred compensation, the timing of deferral elections and of distributions. While technically deferred compensation is any arrangement where an employee receives wages after they have earned them, the more common use of the phrase refers to non-qualified deferred compensation and a specific part of the tax code that provides a special benefit to corporate executives and other highly compensated corporate employees. Non-qualifying deferred compensation is a written agreement between an employer and an employee where the employee voluntarily agrees to have part of their compensation withheld by the company, invested on their behalf, and given to them at some pre-specified point in the future. Non-qualifying differs from qualifying in that deferred compensation is also sometimes referred to as deferred comp, qualified deferred compensation, DC, non-qualified deferred comp, NQDC or golden handcuffs. Deferred compensation is only available to employees of public entities, senior management, and other highly compensated employees of companies. Although DC isn't restricted to public companies, there must be a serious risk that a key employee could leave for a competitor, and deferred comp is a sweetener to try to entice them to stay. If a company is closely held, i.e. owned by a family, or a small group of related people, the IRS will look much more closely at the potential risk to the company. A top-producing salesman for a pharmaceutical company could easily find work at a number of good competitors. A parent who jointly owns a business with their children is highly unlikely to leave to go to a competitor. There must be a substantial risk of forfeiture, or a strong possibility that the employee might leave, for the plan to be tax deferred. Among other things, the IRS may want to see an independent, unrelated, board of directors evaluation of the arrangement. Qualifying. A qualifying deferred compensation plan is one complying with the ERISA, the Employee Retirement Income Security Act of 1974. Qualifying plans include 401k, for non-government organizations, 403b, for public education employers, and 501c3, non-profit organizations and ministers, and 457b, for state and local government organizations. ERISA has many regulations, one of which is how much employee income can qualify. The tax benefits in qualifying plans were intended to encourage lower to middle income earners to save more, high-income earners already having high savings rates. As of 2008, the maximum qualifying annual income was $230,000. So, for example, if a company declared a 25% profit-sharing contribution, any employee making less than $230,000 could deposit the entire amount of their profit-sharing check, up to $57,500, 25% of $230,000, in their ERISA qualifying account. For the company CEO making $1 million per year, $57,500 would be less than 1/4 of his $250,000 profit-sharing cut. It is for high earners like the CEO that companies provide DC, i.e. deferred compensation plans. In an ERISA qualified plan, like a 401k plan, the company's contribution to the plan is tax deductible to the plan as soon as it is made, but not taxable to the individual participants until it is withdrawn. So if a company puts $1 million into a 401k plan for employees, it writes off $1 million that year. Agreements. Plans are usually put in place either at the request of executives or as an incentive by the board of directors. They're drafted by lawyers, recorded in the board minutes with parameters defined. There is a doctrine called constructive receipt, which means an executive can't have control of the investment choices or the option to receive the money whenever he wants. If he is allowed to do either of those two things or both, he often has to pay taxes on it right away. For example, if an executive says with my deferred comp money, buy 1,000 shares of Microsoft stock, that is usually too specific to be allowed. If he says put 25% of my money in large cap stocks, that is a much broader parameter. Again, ask legal counsel for specific requirements. Taxation. In an ERISA qualified plan, like a 401k plan, the company's contribution to the plan is deductible to the plan as soon as it is made, but not taxable to the participants until it is withdrawn. So if a company puts $1 million into a 401k plan for employees, it writes off $1 million that year. If the company is in the 25% bracket, the net contribution is $750,000, because they didn't pay $250,000 in taxes minus 25% of $1 million. Why? Because the cash flow is still $1 million to the plan to be withdrawn later by the employees. Then when tax returns are filed, since the taxable profit is $1 million less, there is an on-paper savings at the 25% tax rate. In an unqualified deferred comp plan, the company doesn't get to deduct the taxes in the year the contribution is made, they deduct them the year the contribution becomes non-forfeitable. For example, if ABC Company allows SVP John Smith to defer $200,000 of his compensation in 1990, which he will have the right to withdraw for the first time in the year 2000, ABC puts the money away for John in 1990, John pays taxes on it in 2000. If John keeps working there after 2000, it doesn't matter because he was allowed to receive it, or constructively received, the money in 2000. Other circumstances. Most of the provisions around deferred comp are related to circumstances the employee controls, such as voluntary termination. However, deferred comp often has a clause that says in the case of the employee's death or permanent disability, the plan will immediately vest and the employee, or estate, can get the money. Deferred compensation as incentive. When agents remain with an employer for a long period of time, there is no necessary reason why the employer should pay the worker his expected marginal product in all periods. Instead, workers could be paid better in some periods than in others. One aspect of this that has attracted both theoretical and empirical interest has been deferred compensation, where workers are overpaid when old, at the cost of being underpaid when young. From this perspective, part of the reason why older workers are better paid than younger workers is not that they are more productive, but simply that they have accumulated enough tenure to garner these contractual returns.